stop whatever you are doing for a moment. If you received Social Security, SSI, or SSDI benefits, the next few minutes may help you avoid a financial scare that many Americans are currently experiencing. A newly implemented banking compliance policy has already taken effect. Not next month and not sometime next year, but right now, and it has the potential to delay your benefit deposit by 24 to 72 hours without any prior notice. Before we continue, I want to ask a quick favor. If this channel has ever helped you stay updated about your benefits, please consider pressing the subscribe button and turning on the notification bell. Our goal is to keep you informed about every change that could affect your money, and subscribing helps this information reach more people who truly need it. It takes only a second, and it means a lot to us. Thank you. Now let's walk through exactly what you need to understand to safeguard your benefits. Tonight, we are discussing an important shift in the financial system that directly affects millions of Americans who depend on federal benefits. If you rely on Social Security to cover housing costs, purchase groceries, or refill essential prescriptions, what we are about to explain is extremely important. This new banking rule is officially active. This is not another rumor spreading across social media. It represents a real adjustment to the compliance standards used by financial institutions throughout the country. Let me make something very clear right from the beginning. This rule does not reduce your benefits. It does not change the formula used to determine your monthly payment. Your eligibility remains exactly the same as it was yesterday. However, and this is very important, it changes the process of how and when your Social Security deposit appears inside your bank account. For many beneficiaries, the transition will happen smoothly without any noticeable difference. But for others, it may appear as a short delay, a temporary hold, or in rare situations even a return deposit that must be reviewed. Even a single 24-hour delay can feel overwhelming when you are living month to month. Many of you likely understand exactly what that situation feels like. This shift is not coming directly from the Social Security Administration itself. Instead, it comes from updated banking requirements that instruct financial institutions to more carefully screen and verify incoming federal deposits, including SSI and SSDI payments. To understand why this updated banking rule is creating discussion across the country, we first need to understand how a Social Security payment actually travels from Washington, D.C. to your local bank account. Many beneficiaries assume the process is a simple, direct transfer. It might seem like the Social Security Administration simply sends money straight into your account. But the real process is much more complex. It involves several electronic layers working together. Here is how the process actually works. The journey begins when the Social Security Administration sends very large payment files to the US Treasury several days before your scheduled payment date. After that, the Treasury distributes the funds through the automated clearinghouse network, which is often called the ACH system. Think of the ACH as the central highway used for electronic payments across the nation. Millions of financial transactions travel along this network every single day. Under the newly activated compliance rules, this digital highway now includes more security checkpoints than before. In the past, if the routing number and account number matched correctly, the deposit was usually processed immediately without additional questions. It was simple and very fast. Now, however, the Treasury and the ACH network have added stronger verification layers specifically designed to detect attempts to redirect federal payments fraudulently. This means even if the Treasury sends your money exactly on time, your bank must now run automated identity and fraud checks before those funds appear in your available balance. For most individuals, this process happens within milliseconds during overnight processing, You will not notice anything unusual. But for some beneficiaries, this additional security screening can create a short gap between the moment the funds reach the bank and the moment the money becomes visible in your account balance. The key point to understand is this: your money is not missing. Your money is simply sitting in what can be described as a high-security digital waiting room, while the bank confirms everything is legitimate. So why are banks suddenly applying this extra caution? The reason is the rapid growth of benefit-related scams and identity theft. Over the past 2 years, criminals have developed more advanced strategies. Some attempt to impersonate beneficiaries and change direct deposit instructions in order to redirect payments into fraudulent accounts. The financial losses from these scams have reached billions of dollars in targeted federal benefits. Because of that situation, federal authorities have encouraged financial institutions to act as a final protective barrier against these crimes. This is where the additional caution comes from, where, unfortunately, that caution can sometimes create temporary inconvenience for honest citizens like you and me. Under these updated procedures, banks are not only reviewing account numbers anymore, they are now studying behavior patterns. Here are several things the system reviews. First, the bank verifies whether the name attached to the Social Security payment exactly matches the name listed on the bank account, including middle initials. Second, the system checks whether the account was recently opened or recently modified. Third, it examines whether there have been sudden changes regarding where the money should be deposited. If the bank's automated software detects even a small difference, such as a missing middle initial or a nickname instead of a full legal name, it may trigger what is known as a review hold. During this review stage, which may last between 24 and 72 hours, the bank performs additional identity verification before releasing the funds. It is important to remember one thing. A review hold does not mean your benefits were cancelled or reduced. It only means the bank is performing a protective verification to make sure your money reaches the correct person rather than a criminal. Let me describe a real-world example that helps explain how this rule works. Imagine a retiree we will call Mary Thompson from Ohio. Her experience illustrates how these procedures may affect someone in real life. Mary had used the same local credit union for many years. When that branch eventually closed, she switched her banking to a larger national institution. About 3 weeks before her March benefit payment, she updated her direct deposit information through her online My Social Security account exactly as instructed. Her payment was scheduled for the second Wednesday of the month based on her birth date. On that morning, the Treasury sent the funds right on schedule. However, because this was the first federal deposit arriving in Mary's new account, the bank's automated compliance filter classified it as higher risk. The system recognized a recently opened account that had no previous history of Treasury payments suddenly receiving a substantial deposit. As a result, the system paused the transaction for identity confirmation. Mary checked her phone early that morning around 6 o'clock and did not see the payment. Immediately she became worried. She feared her benefits might have been reduced or cancelled. She wondered if she had made an error while submitting the update form. She spent most of the morning feeling stressed and concerned about paying upcoming bills. By the next afternoon, roughly 30 hours later, the bank completed its verification and released the full payment. Nothing had been deducted and her benefits remained exactly the same. But for Mary, that short delay felt extremely stressful. Her story demonstrates how technical banking changes can create real emotional stress for ordinary people. When conversations about new rules begin spreading, it is easy for fear to fill the gaps in understanding. Therefore, I want to clearly explain what this rule does not mean. It is not a secret reduction in benefits. It is not a change in eligibility rules. It does not restructure the Social Security program. Retirement benefits are still calculated using the same lifetime earnings formulas. If you receive SSI, your benefit is still based on the same income limits used previously. If you receive SSDI, your eligibility continues to depend on your disability status and work credits. None of those fundamental structures have changed because of this banking update. This adjustment only affects the verification layer between the US Treasury and your personal bank account. Think of it like installing a security gate at the entrance of a neighborhood. The gate may take a few extra seconds to open while identification is checked, but it does not change your home or your right to live there. Most people who have used the same account for years without changes will probably never notice any difference at all. Their deposits will likely arrive exactly the same way they always have. I am explaining this today so that if you ever notice a small timing change, you will recognize it as a security check rather than a loss of benefits. While many beneficiaries will experience no change, there are certain situations that now increase the chances of a temporary bank review. Let us examine them so you can evaluate your own circumstances. Trigger number 1 involves recent banking changes. If you opened a new checking account during the last 30 to 60 days, or recently changed where your benefits are deposited, your first few payments may receive additional scrutiny. Banks consider newly connected accounts slightly higher risk until a consistent monthly pattern becomes established. Usually, after 2 or 3 successful deposits, the account is considered normal. Trigger number 2 involves name differences. This might seem like a minor detail, but automated systems treat it seriously. If your Social Security record lists Robert J. Williams, but your bank account lists Bob Williams, the software may request a manual verification. Even a missing middle initial or a suffix like junior or senior can create enough discrepancy to delay a deposit briefly. Trigger number 3 involves dormant accounts. If an account has not been used for several months and then suddenly receives a large federal payment, the fraud filter may pause the transaction temporarily to confirm that the account has not been accessed without authorization. In simple terms, consistency helps your deposit move faster. When your banking information remains stable, the payment process usually moves smoothly through the system. For people who share financial management responsibilities, the new rule also introduces additional considerations. Joint accounts and representative payee arrangements may now receive closer verification. Consider the case of joint accounts. If the main account holder is a spouse or family member, rather than the Social Security beneficiary, the automated system may flag the deposit as a potential mismatch. This situation can occur especially for SSI recipients who use a representative payee to manage funds. Banks must verify that the person receiving the payment is authorized to manage it for the beneficiary. These arrangements are completely legal and very common. However, automated systems do not fully understand family relationships. They only compare names between Treasury files and internal bank records. If you use this type of account, there is no need to panic. Your benefits will not disappear. But a short verification delay could occur. To reduce that possibility, you may wish to contact your bank and confirm how the account is coded internally. Make sure the beneficiary's Social Security number and legal name are correctly attached to the account record. A brief proactive phone call to the bank's support or compliance department can sometimes prevent confusion later and ensure the automated system recognizes your arrangement correctly. Timing also plays a major role when you are waiting for a deposit. Some confusion surrounding this rule simply comes from misunderstanding the Social Security payment calendar. Social Security follows a structured schedule. SSI payments usually arrive on the first day of the month. People who began receiving benefits before May 1997 typically receive payments on the third day of each month. For everyone else, payment dates are determined by birth dates and arrive on the second, third, or fourth Wednesday. Situations can become slightly complicated when payment dates fall immediately after federal holidays. The Treasury sometimes releases funds slightly earlier to account for those holidays. However, banks under stricter screening procedures may use additional time to complete fraud verification checks. Because of this, your deposit might appear later in the day rather than early in the morning. In an environment where rumors spread quickly online, a few hours can cause unnecessary worry. Someone might claim benefits are being frozen simply because their deposit arrived several hours late. In reality, these small timing differences are often caused by routine banking processing combined with holiday scheduling. Understanding your specific payment Wednesday and monitoring the calendar can help you distinguish normal processing delays from genuine problems. Now let us discuss another financial topic that sometimes surprises retirees. While the new rule focuses on incoming benefit deposits, there is also an older regulation that is being enforced more consistently. This rule is known as the Currency Transaction Report, or CTR requirement. Under federal law, any cash transaction exceeding $10,000, including deposits, withdrawals, or transfers, must be reported by the bank to the government. Many people become nervous when they hear this, but a CTR is not a penalty, and it is not an accusation. It simply documents large cash movements within the financial system. In earlier decades, these reports might have remained stored in files. Today, they are quickly processed through automated systems used by tax authorities. If you sell a vehicle for $12,000 in cash and deposit the money, your bank will complete the report automatically. For most honest citizens, nothing further happens. Problems can arise only when large deposits do not appear consistent with reported income. There is also one behavior that can unintentionally violate federal rules. It is called structuring. Structuring occurs when someone intentionally divides a large transaction into smaller amounts to avoid the $10,000 reporting threshold. For example, imagine someone receives $12,000 from a legitimate sale. Instead of depositing the entire amount at once, they deposit $6,000 one day and $6,000 later, hoping to avoid a report. Even though the money is legal, the intentional division of the deposit may be interpreted as structuring. Modern banking software analyzes transaction patterns and may recognize the timing and intent. In some cases, penalties for structuring violations can reach $10,000 or more. The safest approach is very simple. If you have a large, legitimate cash amount, deposit the entire amount at once and allow the bank to complete the required report. Transparency is far safer than attempting to avoid documentation. Today's banking world is very different from the systems used decades ago. Financial reporting and verification are now largely automated. Systems connect information from many sources, including bank reports, Social Security payments, pension distributions, and digital payment records from financial apps. The goal is not to target individuals, but to detect mismatches between financial data. For retirees, this simply means maintaining clear records for major transactions. Documentation is your best protection. When your records match your financial activity, there is rarely any problem. Let us consider two simple examples where retirees sometimes create confusion unintentionally. First, imagine someone sells personal property, such as an RV for $18,000 cash. If they split the deposit into two smaller amounts, it may trigger structuring alerts. The better solution would be depositing the full amount and keeping a signed bill of sale showing the buyer name date and price. Second, consider receiving a large family gift, such as $15,000, from a relative during a difficult time. Gifts are generally not taxable income for the receiver. However, without documentation, the deposit may appear unexplained. A simple gift letter from the giver explaining the amount and confirming it is a gift can resolve any questions if they ever arise. Remember, the tax system focuses on income rather than deposits. The key is being able to explain where funds came from when necessary. Today we covered a great deal of information. From new banking verification procedures that may slightly affect Social Security deposit timing to automated financial reporting systems, it can sometimes feel complicated. The most important message is that knowledge helps you stay protected. These rules are intended to prevent fraud and ensure federal payments reach the correct recipients. Let me summarize several helpful steps you can take. First, confirm that the name on your bank account matches your Social Security record exactly, including initials and spelling. Second, if you receive a large amount of legitimate cash, deposit it in a single transaction instead of dividing it. Third, keep basic documentation for significant financial transactions such as sales receipts or gift letters. Fourth, maintain a small buffer in your account, even $100 or $200, so a short delay will not interrupt bill payments. Fifth, if you use a joint account or representative payee arrangement, contact your bank to confirm the account details are correctly recorded. Most importantly, do not let rumors or online panic shape your expectations. Social Security benefits continue to be issued, and the payment system continues functioning normally with stronger protections. By verifying your information, staying organized, and maintaining a small financial cushion, you remain in control. You worked many years to earn these benefits, and you deserve to enjoy them with confidence. Stay informed, stay prepared, and you will stay protected. Thank you for watching, and if this video helped you, please subscribe and share it with someone who may benefit from this information. Until next time, take care and stay safe.